Hey everyone, and welcome to the Explainer. I am absolutely thrilled to guide you through today's topic. We're stepping into the high-stakes, kind of invisible world of financial trust. Just think about the global economy for a second. Trillions of dollars change hands, massive corporations operate across borders, and millions of everyday people invest their hard-earned money into businesses they'll literally never physically step foot inside. Well, whether you realize it or not, your retirement fund, your savings, and just the overall health of your bank account rely on a very specific, carefully constructed framework of accountability. So it all starts with this incredibly relatable, fundamentally human question. If someone else manages your money, how do you know they aren't lying? Right? Whether it's a retirement fund, a stock portfolio, or a business partnership, investing inherently means handing over control to somebody else. And that core vulnerability, that separation between the person who owns the money and the person who manages it, creates a really fascinating psychological and economic puzzle. To understand how we actually solve that puzzle, we've got to ground our thinking in what's called agency theory. This is the relationship and the inherent conflict of interest that pops up whenever one party, the principal or the owner, employs another party, the agent or the manager, to perform a service on their behalf. It's honestly a brilliant way to view corporate structures not just as, numbers on a spreadsheet, but as fundamentally human relationships driven by competing motivations. Okay, let's dive into this, because this is where the friction really happens. This is the agency dilemma. If you're a shareholder, the principal, your primary goal is asset growth, right? You want to maximize your return on investment. But if you're a director, the agent, you have a duty of stewardship, sure, but you're also a human being who might want a bigger bonus or maybe a company jet. So the problem? If the directors pay themselves more, the assets of the company naturally go down. It's an unavoidable conflict of interest built right into the very DNA of modern business. Now, you might be thinking this is just a modern Wall Street problem, but it's actually ancient. Humanity has literally been trying to solve this for millennia. Back in ancient Egypt and Rome, independent checkers reviewed tax collectors. And trust me, the penalties for cooking the books back then were a whole lot worse than just getting fired. Then, in medieval Britain, feudal barons hired independent reviewers to make sure tenant farmers were accurately reporting their revenues. And today, we have super sophisticated corporate laws, like the Companies and Allied Matters Act, or CAMA 2020 in Nigeria, which legally mandate that every public liability company must have its annual financial statements audited. So the problem is ancient, but our solution has just become deeply, deeply systematized. So, how exactly do we bridge that gap of trust? Well, that brings us to part one, the mechanism of trust. What is an audit? All right, here is our formal definition. Auditing is an independent examination of an entity's records by an appointed, qualified person to form an opinion on the truth and fairness of the financial statements. Now, I want you to focus on two massive words right there: truth and fairness. In this context, truth means the information is factual. It perfectly conforms to reality and contains no material errors. Fairness means the information is entirely free from discrimination or bias. It's not just about the math being correct, it's about the whole picture being totally honest. And to ensure that level of honesty, an auditor can't just be anyone off the street. They are bound by 7 strict ethical principles. We're talking independence, integrity, and objectivity, alongside professional competence, confidentiality, professional behavior, and a rigid adherence to technical standards. An auditor literally has to be independent, not just on paper, but in their actual attitude and state of mind. They must be seen as completely separate from the management they're evaluating. So the really crucial point here is how an auditor actually approaches their job mentally. They employ what's called professional skepticism. What this means is that an auditor neither assumes management is totally dishonest, nor do they assume unquestioned honesty. They operate with a highly critical, questioning mind. If management says, hey, this piece of equipment is worth $1 million, the auditor doesn't just nod and write it down. A representation from management is absolutely never a substitute for hard, verifiable evidence. Trust but verify, right? But despite all of these rules, the public actually largely misunderstands what the job is. So let's bust some major myths in part 2. The twist, the expectation gap. Now, what's really interesting about this is the stark contrast between public perception and professional reality. It's known as the expectation gap. See, the myth out there is that an audit acts as this sort of magic shield, that it detects absolutely all fraud, guarantees the company will survive tomorrow, and certifies the accounts are 100% mathematically flawless. But look at the reality. An auditor only expresses an opinion. They provide reasonable assurance, not absolute assurance, and they focus purely on material misstatements, basically errors that are big enough to actually change a shareholder's decision. So let's define that incredibly important term. Reasonable assurance is a high-level conclusion that the financial statements are free from material misstatement, while openly acknowledging that absolute assurance is just simply impossible. It is the gold standard of auditing for sure, but it is not a guarantee of absolute perfection. Now, you might be wondering, why can't we have absolute assurance? Well, there are just some unavoidable limitations. First off, auditors use sample testing. I mean, they don't check every single pencil bought or coffee poured over an entire year. Second, there are inherent limitations in any system, like when two managers decide to collude to hide a fraud. Third, most audit evidence is persuasive, not 100% conclusive. And finally, a whole lot of accounting actually relies on estimates and professional judgment. An auditor can't magically guarantee the future, they can only assess the reasonableness of the present. So, how do they actually achieve this reasonable assurance in practice? Let's jump to part 3, behind the scenes, anatomy of an audit. The process of auditing is highly systematic. It basically boils down to these 5 distinct phases. First, you carefully plan and control the work. Second, figure out how the client actually records their transactions. Third, roll up your sleeves and obtain the reliable audit evidence. This is the actual fieldwork. Fourth, stress test the company's internal controls to see if they hold up under pressure. And finally, take all that evidence, review the overarching financial statements, and form that crucial independent opinion. It's essentially a rigorous, step-by-step scientific method applied directly to money. And this brilliantly illustrates a really vital distinction you need to understand: the difference between external and internal auditors. External auditors are the independent watchdogs. They are literally required by company law. They absolutely must be professionally qualified, and they report directly to you, the shareholders. Internal auditors, on the other hand, they're employees. They report to management, their mandate is decided by management, and their primary job is to just monitor daily operational efficiency. Both are totally important, but only the external auditor provides that true, unbiased public trust. But wait, if external auditors are hired to check the management, who stops management from bullying the auditors or, threatening to fire them if they don't get a clean report? Enter the audit committee. This is the buffer. Under laws like CAMA 2020, this specific 5-member group, composed of 3 shareholder members and 2 non-executive directors, is explicitly designed to create a safe, dispassionate space between the external auditors and the internal company directors. And they are definitely not just figureheads. They have real teeth to enforce these rules. The audit committee reviews legal compliance, they review the actual scope of the audit, and most importantly, they are the ones who recommend the appointment, removal, and the pay of the external auditors. Management doesn't dictate the auditor's paycheck, the audit committee does. Actually, this structural separation is absolutely vital to keeping the auditor fiercely independent. Okay, we've covered the history, the psychology, the myths, and the mechanics. Now for part 4, the bottom line, the power of assurance. It really all circles back to this core objective from our source material. The primary objective of an audit is to enable the auditor to express an opinion whether the financial statements give a true and fair view. At the end of the day, an audit is not some magic guarantee against all evil. It is a manufactured, highly regulated system designed to lend credibility to stewardship. It literally transforms a company's self-reported financial claims from just a biased promise into a verified, trustworthy asset. Which leaves us with this final, sweeping question to ponder. Without the reasonable assurance provided by external auditors, could the modern global economy of separated ownership and management even exist? Honestly, if we couldn't trust the numbers, the flow of global capital would just completely freeze. Auditing might seem like dry compliance on the surface, but it's actually the invisible bedrock of trust that keeps the entire financial world spinning. Thank you so much for joining me on this explainer, and definitely keep questioning the numbers.